Good evening. This is Ken Long from Tortoise Capital with a review of the daily trading plan for April 16th, 2011. We have a market that's in bullish normal. On an annual basis, it's at 64 on the weekly RSI, so slightly above the midpoint. 47 on the 10-day index, so we're slightly below fair value on a 10-day look back. The 200-day moving average percent stretch is 9.90%, which is in the white, so it's been better, but it's still above average, and that's generally bullish. The slope of the 50-day moving average, however, has dropped down to 0.15, and that's, even though that's favorable or positive slope, that's at the weakest, among the weakest readings we've had in the last 6 months, so that's why it's coded in red and considered bearish. ADX 14 is at 14.1, which is a very weak or untrending market. And you can see down here on the ADX reading that it's come down from a high above 35, and with minus DI above, plus DI, the bearish price action has actually been stronger than the bullish. The ATR percentage at 0.89 is at the low range of normal, as you can see on the SPY volatility chart. It's come back almost 3.5 standard deviations to be at the low range of normal, and that has been generally a favorable place to be. However, with it looking like it could hook and start to go back up, that will be actually unfavorable for longer-term trends. Inside the gap stat, what we have is a 60% probability in the last 30 days, or 60% of the time, the market has reversed its morning gap. So it's either gapped down and reversed to close higher, or gapped up and reversed to close lower. It's done that 18 times out of 30. We have a perfectly symmetrical market here, as you can see. It's gapped down and reversed 9 times. It's gapped down and then continued to fail 6 times. It's gapped up and reversed 9 times. It's gapped up and then continued to gain for an additional 6 times. It's hard to see any other pattern other than that tendency to be reversing intraday. The maximum favorable average move in SPY, what we call the gap stat, that's the average plus a standard deviation of the range of the last 30 days, is 1.61%. That's the boundary of rational exuberance. Moves beyond that range are starting to get extended intraday. You can see on the 10-day index NDX time series that we're slightly below the midpoint after coming out of oversold conditions. No signals on the overreaction and channeling. The last couple sets of signals were favorable, and we're still in those trades. You can see the pivots at 132 approximately in SPY. 10-day max pains, some favorable trading targets there: Alcoa, Bank of America, Cisco, JP Morgan, and Caterpillar. We're going to see that the financial spider is extremely oversold, and so now there's a good possibility of a reversion to the main trade in financials, which would cause us to be looking very seriously at JP Morgan because of its oversold conditions as well. Among the ETF 100, the VIX, oil services, it says XOP is a oil and service, an oil and exploration ETF, metals and mining, and then Russia. Russia because of a weakness in energy lately. Among the pattern trades, 551Ws predominate with decent moves on Friday. So we're looking at agriculture, blended commodities, emerging markets, Latin America, technology, spiders, and energy. Now, a number of these have been oversold and could be in the day one of bouncing. I would classify that as the technology and the energy and the commodities. Emerging markets have been very strong, so that could be a continuation play setting up there. Among the stocks, Boeing, Chevron, and ExxonMobil. I like that, the signaling of strength among the energy. So energy has given back in the last 10 days quite a bit. So if we see XLE outperforming SPY, then we should be on whichever one of these oil companies, in this case Chevron or ExxonMobil, is leading the way. Financials are in a channeling or oversold condition, and so we're looking for a bounce there. JP Morgan is also a channeling, as well as being a 10-day max pain, as is Alcoa. Just a quick review of the daily tactical summaries for the Dow 30. You see quite a few doji patterns, and then channeling signals in Alcoa and JP Morgan, and then the 551Ws again you see in Boeing, Chevron, and ExxonMobil. The percent winners on Friday: Chevron, DuPont, Merck, and Procter & Gamble. I mean, you just have to love Procter & Gamble as a dividend payer. Very solid company. Should always be on your short list of things to hold during stormy weather. On the percent losers: Bank of America, Cisco, and United Technologies. Again, you can see just how bad Bank of America has been. It's been among the worst of the financials. You can compare it to JP Morgan, which has only recently been painful here, as indicated by the red highlights. But Bank of America has been as bad as anything has been in the Dow over the last year by any measured look-back period. Among the ETFs 30, you can see just the difference between the VIX and silver jumping out at you. Silver powerful by any look-back period. The VIX suffering by any look-back period as well. Not as many dojis as the Dow, but still quite a few to choose from. Channeling signal in the financials. Lots of 551W patterns, including the market itself. And so that is a condition which says you can reward next day momentum in a big way, because it's been positive on 5 weeks, had a little pullback, and then already has 1 day of momentum in hand. So you can buy day 2 momentum in a large way. One of my favorite patterns. Supplementals. I modified this page a little bit, and I'm giving you a picture of the slope of the 30-day regression line in the northeast quadrant. The blue is the time series. The black line is the 10-day moving average of that time series. And so crossovers, vicinity, and extreme condition are very interesting to us. And you can now, what I've done is added this new zoom in on the last 30 days of the slope. Now this is the same chart as the last 30 days of the northeast quadrant, and you can see a crossover occurred. Now you can map that directly to the price action above. Right where my cursor is, right about 15 days ago, was the latest crossover, and so that is actually a favorable price action. I like the lazy W pattern in price, and then that's supported by an improvement in that 30-day regression line. That percent stretch above and below the 200-day moving average. We bounced off on 1 standard deviation, and we're still at about 3/4 above average considering the last 180 days. And so there's still room to go back up and test 135. The next test will be large and tell us if there's any legs left in this bull. We've had 2 good long moves up, and then a small pullback, and then a larger test of the 10% pullback level. We didn't get as high as 135, and now we've got some. We want to see some follow through here from the bull in pretty short order. Just a quick reference on the range statistic, and the safe zone channel. The market has been basically sideways in a tactical mode these last 10 days or so, and reference data for the gap stats for all the usual suspects among the ETFs. In the quality report, again, what I like to look for is red in the 2-month look-back period, followed by improvements like in yellow and white. So I'm really stalking Procter & Gamble, Walmart, and Microsoft. All those are favorable for us. To a slightly lesser extent, Merck, because the difference between its 2 months ago and 1 month ago quality numbers is highlighted in green in this divergence column. You can make the same case for American Express, and AT&T. So American Express being on that list tells us that if we see strength in the financials, American Express could very easily be the leader out of the financial hole, and so we'll be stalking that one carefully. Same chart, but now for the ETFs. Natural gas has been a tactical trade, but is still suffering. But it's the only one that's in the red on 2 months ago and is white now, and so it remains a tactical target for us as long as it's above 11. We can play momentum on it pretty nicely. Other candidates are China and emerging markets. As you can see, even though they are in the yellow, their divergence is in the green, and along with XLP, consumer staples. And that leads us back to Procter & Gamble as a low-risk idea for emerging and continuing strength among the Dow leaders. The slope of the 30-day regression line of each of the major indexes, after we've subtracted out SPY, that gives us a representation of the alpha that's contained in each of the indexes. You can see the commodities are starting to reassert themselves here, each in an upswing for blended commodities, oil and gold. Among the U.S. indexes, they have almost all come back to the zero line or at parity with SPY. And the one that's on the rise the strongest is the mid caps and then the small caps. The technology, you can see this little sell-off here has been very disappointing. They have not been able to maintain pace with the rest of the broad market. The internationals here, EFA and is probably the strongest looking one, although I expect to see more strength in Latin America because it's neither Asia nor the Middle East. Only silver was measurably stronger on Friday based on the Elder Safe Zone channel that we've adapted. Very powerful move again on silver. Quick look at the percent winners and losers over the last 10 and 30 days for your reference. And then the furthest right column is what they actually performed on Friday. One of the things that you'll notice is that it's not unusual to see extreme moves among these extreme winners and losers. So among the extreme winners, for example, you'll see quite a few momentum plays that happen on Friday, but also some give-backs among the percent winners. And even among the percent losers, you can see everything that's highlighted in a green in this column are ones that bounced very strongly on Friday. So the extreme conditions promote extreme reactions. That's why I like to stay there. Quick look at daily pivots among multiple time frames for all the usual suspects and a number of other interesting stocks. And a summary of the gains of various holding periods in the lifespan of these major indexes. I use these as an indicator to help me understand the context of the most recent moves. Like when we've seen a good move or what we feel like is a bad move, we can use this chart to put it in historical context, looking back the last 5 years to see exactly how extreme that condition is. It's a way to calibrate our beliefs and our feelings about the move that we're in. Correlation coefficients. And that's all for the daily report. So again, we have a number of candidates that we should be looking at. Financials, silver, energy sector on a rebound, U.S. mid caps and small caps, and then continued strength in China and Asia less Japan. So good hunting. This is Ken Long from Tortoise Capital. Keep your powder dry and your risk measured.